Picture this. The investment markets are volatile and uncertain. It's not easy to pick investments, to monitor your portfolio, and to make adjustments during uncertain times. You might even be a newbie to investing, and all of this, well, might just be too much for you. We have the solution. Now you can use Auto Invest, SoFi's new Robo Advisor, to build a global, diversified portfolio for you. Auto Invest not only monitors your portfolio for you, but it automatically makes adjustments when the market changes. It's a bit like letting an experienced investment advisor look after your investments for you. Except the advisor is an artificial intelligence that always monitors your portfolio and is probably a lot cheaper to hire. We're going to explain to you what a robo-advisor is, why you might use one, and how to get started. First, let's start off with the why. Suppose you want to put some money away and save up for a goal. That new phone, Chanel bag, a holiday, or perhaps even an apartment down payment. You could put some money in your savings account, but you make very little return with such low interest rates now. Investing in stocks is a great idea, but stock markets are complicated, unpredictable, and time-consuming. You could spend hours studying them and monitoring your investments, but you might still make a loss even if you've done all the work. After all, even the professionals get it wrong quite often. Our robo-advisor is an algorithm that allocates your money for you into a well-designed and diversified investment portfolio. The portfolios have exposure to 13,000 stocks around the world in over 35 countries and have exposure to equities, bonds, and commodities. A robo-advisor constantly monitors your investments. A robo-advisor is never emotional. It won't panic and make rash decisions if the stock market fluctuates, or become too excited when your investments make a lot of gains. Just think of it as that reliable friend who always seems to do the sensible thing for you. How does a robo-advisor do this? You've probably heard of all the common investment advice. Manage your risk, don't put all your eggs in one basket, diversify. You probably understand some of those concepts, but do you always do that? A robo-advisor does all of those things for you, and consistently. When you make an investment in a robo-advisor, you're putting your money into a diversified portfolio of exchange-traded funds, also known as ETFs. ETFs are like baskets of different investments. It might include stocks, bonds, or commodities. These investments are usually spread across different markets and industries and are picked by experienced fund managers. ETFs are usually well diversified, meaning you don't put too much risk on one type of investment. Sure, you can probably invest in these ETFs yourself, but you probably wouldn't monitor your investments on a daily basis, calculate what adjustments need to be made, and then sell and buy precise quantities to keep your portfolio diversified. After all, it's a lot of work, and something an artificial intelligence will do much better. Our robo-advisor will manage your risk and keep your portfolio diversified. Putting too much money on one investment is risky, because if the value goes down, well, that's bad news. So how exactly does a robo-advisor monitor for you? It's called rebalancing. A relatively straightforward process, but performed with a high degree of accuracy by a well-designed algorithm. On a regular basis, the robo-advisor's algorithm will sell the ETFs in your portfolio that are comparatively performing well. It then reinvests this money into other ETFs in your portfolio that have diminished in allocation size because the better performing ETFs now make up more of your portfolio. It probably sounds counterintuitive to sell off your best performing investments, but it's actually the sensible thing to do. If you allow that one ETF to begin to dominate your portfolio, it becomes unbalanced, and you begin to increase your risk as more of your money goes into one type of investment. By redistributing the money to other ETFs, your investment profile is kept balanced and diversified, lessening the chances of you experiencing big losses if one of the investments fluctuates. Again, you could do this yourself, but you need to constantly monitor your portfolio and make calculations to help you decide what to sell and buy. This is especially the case if you have a large portfolio of investments. You could also hire an investment manager to do this for you, but they're expensive, and why should you pay for their fancy offices? Instead, you could do it cost-effectively with an algorithm that is always calculating and always making sensible decisions based on data and never on emotions. You could rely entirely on a robo-advisor, But you can also have a Robo Advisor investment alongside stocks, ETFs, and other investments you manage yourself. After all, having a diverse range of investments is also considered a good investment strategy.
So what sort of performance could you potentially expect from a Robo Advisor? Well, 5 years ago, we launched Asia's first Robo Advisor, and some members earned up to 19% cumulative return in 1 year.
Interested? Let's show you how to set up an investment on our Robo Advisor, Auto Invest. Setting up an investment is as easy as 1, 2, 3. On the SoFi app, just tap Auto Invest. Then fill out the risk profile questionnaire. This tells our Robo Advisor your tolerance to risk, so it can customize an investment portfolio for you. The ETF portfolios that are available to you are based on your risk profile questionnaire. If you're a risk-intolerant person, you'll get a selection of low-risk ETF portfolios. So select an investment portfolio and make an initial investment which can be as low as $100, making it easy for you to start saving for that new phone. You can even set up a monthly direct debit to your investment, so you can build a good habit of investing and saving regularly for the future. This is an investment strategy that some would say is effective. Instead of worrying about trying to time your investment and put all your money in as the markets are good, you invest smaller amounts of your money at regular intervals regardless of the price. This reduces the risk of you putting all your money upfront into the investment, which could cause you a big loss if the price drops. In theory, dividing your money into smaller, multiple purchases maximizes your chances of paying a lower average price over time. This is called dollar cost averaging. If you would like to learn more about robo investing, SoFi has other videos on our app and website. So what are you waiting for? Get started with SoFi Auto Invest.